This video is going to walk through the financial statements. There'll be a quick overview of what the statements are and what they include. So starting over here on the left, you can see we have the profit and loss. The profit and loss is over a period of time, and it shows what happened during that period of time. So we can see here, January 1 through December 31, 2023. And then the next statement is going to be the statement of cash flows. It is again showing over a period of time, in this case from January 1 to December 31, 2023 as well. Now the big difference between the statement of cash flows and the profit and loss is the profit and loss is showing what happened, whereas the statement of cash flows is showing how the cash moved. And what happened does not always equal how cash interacted with the business. Now the last one, it is the balance sheet, and that is going to be for a period of time, or for a point in time. So in this case, it would be December 31st. Often your bookkeeping software may want you to run it for a period of time like this, but just know that it is showing what the balances are in the account at the end of whatever period it is that you run. So for example, cash in this case is $32,100. And that's just what it is. If you were to go to the bank, you would have that balance there. Whereas revenue of $1 million, there's nowhere you can go to just get that $1 million. That's something that happened over a period of time. So now going in a little deeper, starting with the profit and loss, it's broken up into two main portions. That's going to be your business engine and then your business chassis. The business engine, it's the main part of your business. It's what drives the business forward. So in this case, primarily it's going to be your direct costs, your direct purchases, and then your labor. And then the operating expenses or the business chassis, these are the supporting functions that help everything above them up here operate. So if you have an engine that's really large while your chassis is too small, you're going to burn your business out. Whereas if you have a chassis that's too large and an engine that's too small, your business just won't go anywhere. So the big balancing act is to really get the engine and the chassis at the right amount so that you really know, so that the business is moving at a pace that is sustainable yet profitable. Along the way, you can see we have a couple different line items and percentages. So the first here, that's going to be gross margin, which is taking revenue less your cost of goods sold, gives us gross margin. And then we have a gross margin percentage. So that's just taking your gross margin, dividing it by revenue, which gives you your gross margin percentage. Important to keep an eye on that over time. If it starts going down, either you have altered the goods and services that you're providing to lower margin items, or you need to increase prices on what you're selling because your cost of goods sold has gone up. The next section here, that's going to be your labor. And I like to separate out labor from the taxes that are paid on that labor. So this would be like the hourly wage, if it's that, or the salary amount, and just keeping labor separate. We'll see why that is in a moment. The next line here, we have contribution margin, and that's taking gross margin minus labor. So once you have your income number and then you subtract out the direct purchases and the direct labor associated with that, we have the contribution margin. This is the amount that's going to be able to go towards paying off overheads and ultimately will be the profit number. Now, the reason that we keep taxes separate from labor is so that we can calculate this number here, the direct labor efficiency ratio. And that's taking your gross margin, dividing it by labor, and that gives the direct labor efficiency. This is one of the biggest levers that you have in your business often is going to be labor. And so making labor more efficient will bring this number up. And when labor becomes less efficient, it's going to go down. Now, the big thing to keep in mind, as with all numbers, you don't want them too high or too low. You want them just right. If your direct labor efficiency ratio really starts to go up and it continues to climb, it could mean that you've moved into a higher margin service. And that could be a good thing. It could also mean that you're burning your employees out, and you might start to see employees leave and or have employees that are not happy with their workplace. Similar thing when it's going too low. That could be that you have a team member that's unproductive. Maybe they have equipment that's faulty and you need to get it replaced. You may need to be bringing in a supervisor to help organize the work, so on, so forth. So the next stage here is that we have the operating expenses, and those are separated into 5 main buckets. You have facilities. This would include things like your rent, repairs and maintenance, things to keep your facility running, telephone, things like that. You have your marketing, you have your management salaries. So this would be all management and admin labor is going to go into this bucket. And then you're going to have your payroll, taxes, and benefits. Those would be on the labor, and then anything that doesn't fit into one of those categories. Now this way, keeping it simple up front helps it so that you're not looking at a ton of accounts off the bat. Many bookkeeping records are going to have many more accounts than this, and that's needed in order to dig into the details. But at a high level, when you're just looking at the company, these are the main buckets. And when something starts to go off in a bucket, you know to dig in deeper. So after all of this, then we have our net operating income, which is taking contribution margin minus our operating expenses, gets us down to net operating income. Now after that, we're going to have depreciation. So if you have lots of equipment or buildings, things like that, then they would be depreciated over time. That's because usually those items last longer than a year. So you're needing to bring in the expense over time to match the period in which the revenue is earned. And then we have interest, and this is primarily going to be if you have a large interest expense due to long-term debt. Once we get there, we have our pre-tax profit. So that's taking net operating income minus our other expenses, gets us to pre-tax profit. Then you're going to have your corporate tax on that. In this scenario, I'm running it at the small business rate in Canada, specifically in British Columbia of 11%, but this number could go anywhere from 11% up to a lot higher than that, 30+%. And then after it's all said and done, we have our net income, 80,545 in this case. Net income is sometimes also called profit. Just depends on what you're looking at. So then from there, we can take our pre-tax profit as a percentage of revenue. And then sometimes I will also look and see pre-tax profit relative to gross margin. The idea with having these here and in a nice clean format is then over time, so whether you start doing this monthly or annually, anything like that, you can put it over time and then you can compare to see whether you're doing better or worse than the previous period. So the profit and loss shows what happened over the course of the year. Now, this 80,545, pretend this is the first year of this business running. If you were to get to the end of the year, we'd be like, okay, $80,545. I expect to see that in my bank. And you won't see that in your bank. And that's because there's a lot of levers that are going on, or a lot of different actions that are happening that make it so that the actual cash coming in and out of your bank account does not equal revenue. And that's where the statement of cash flows comes in. This is super important to know what the statement is doing and at least understand what is happening. Otherwise, you can find yourself in a cash bind really, really quick. So here, net income 80,545. If we look all the way over up in the top right, then we can see the actual balance is $32,100 in the bank account. That's a lot lower than 80,000. So what we're doing, we can see at the top, we have the 80,545 coming from net income. We go through these adjustments, which we'll talk through in a moment, and we get to the 32,100 that is in the bank. So in this scenario, when we're looking at the statement of cash flows, negative means that we are missing cash. So it's, or maybe not missing is not the correct word, but cash did not go into the bank for some reason. And then when it's a positive, there's more cash or cash went into the bank. So in this scenario, we have accounts receivable of 150,000 negative. So what that means is that we billed out $1 million during the year, yet our accounts receivable, we're still waiting on $150,000 to come into the bank. Inventory, negative 10,000. So that means that we didn't use all of the inventory that we purchased. Some of that went into our inventory account, which you can see is over here on the balance sheet. Here we can also see accounts receivable on the balance sheet as well. Next, we have accounts payable, so 10,000. Now this is a positive. What that means is that we owe someone else $10,000, so we haven't had to pay that out of our bank account yet. Same thing with credit card, same thing with sales tax, payroll tax, corporate tax. So all of our tax accounts, we haven't paid all of our tax yet. We owe that money out. And then equipment depreciation. Remember, we brought this over here on our profit and loss. Now, depreciation does not, it's not an actual cash amount going. We were just saying, hey, out of the original equipment purchase, a portion of it's been used and it's going to be worth a little bit less than what we purchased. So we account for that in the profit and loss to help us get an accurate net income number. However, it doesn't actually affect cash. So that gets us to 32,000 in cash provided by operations. Next, we have investing activities. So in this case, we actually purchased $60,000 of equipment. So that came out of the bank account to purchase the equipment. And what happened here, one little math point is that, so we purchased equipment for $60,000. We expensed $15,000 worth of it. So that gives us $45,000. And that's the number over here in our equipment line. Now, this was the first year, so some shares were bought by the shareholder, leading us to cash provided by investing. We had a total outlay of cash of $59,900. The next section here, we have financing activities. So in this case, we took on a bank loan for $50,000, so we're going to owe $50,000. Now, out of that $50,000 bank loan, we actually repaid $10,000 worth of it already. When we have this interest amount on here, this interest that's all it is. It's the interest portion of your loan payment. It's not the entire loan payment. So this is showing that $5,000 went towards interest and $10,000 went towards paying down the loan. Now here as well, we have shareholder loan and it's a positive. So that means that the shareholder themselves had to put an additional $20,000 into the company in order to just meet cash needs. Okay, so when we take all of these numbers and we add them up, we have our cash provided by operations of $32,000. We had cash provided by investing. And sorry, I should point out that cash provided by operations is including net income. So then we have that. We have cash provided by investing, and we have cash provided by financing for a total cash increase of $32,100. And since our company started just this year, it would have started with an empty bank balance that matches our cash amount. Now, the final statement that we have here is the balance sheet. So that's going to be at a point in time, and it's keeping the score in the business. So it's broken up into three main areas. We have what you own, what you owe, and shareholder capital. Shareholder capital is taking what you own minus what you owe, and that's what's left over. So in theory, if you were to liquidate this business, there would be $80,645 that could go to the shareholders. Now, within that, we have what you own, known as assets, current and long-term. Current is going to be less than a year in terms of when you can turn it into cash. Long-term is going to be something that's usually around for longer than a year. Same on the liabilities side, current less than a year, long-term more than a year. So in here. Then we have our cash, we have our accounts receivable, inventory. We should be able to sell this inventory next year, and we still expect our accounts receivable to be collected. And then of course, cash is going to be what's in the bank. Now we have our long-term assets, we have our equipment, and then down here we have current. So these are all the things we expect to be paid within the year. And then long-term, we have our bank loan that's going to be getting paid beyond a year. And often you would see a portion of this in current as well, because there's usually going to be one portion that's current and then a portion of the loan that is beyond 2 years. We have the shareholder loan, as there's unlikely to be any requirements for the business to pay that back. And then that gets us to the remainder, the equity. Now, two ratios that I look at here, among many others, but it's going to be our current. So that's taking current liabilities divided by, current assets divided by current liabilities. In this point, 1.99, that's quite a good ratio. Now, the one thing that I will run more often, especially in small business, is going to be this cash ratio, where I'm just taking cash, dividing it by liabilities, and it's a bit more to see how much risk is happening in the business. So while you can see we have plenty of working capital, it's called, that's going to be our current assets and current liabilities. We have plenty of working capital there to cover off our liabilities. We actually have very little cash. So this business could be at high risk, depending on is this 150,000 all from one supplier. That could be a high risk thing. If that supplier doesn't pay us back, then we could be in trouble. It's going to be hard to dig out of that hole. When are the payment terms on this? Perhaps some of these amounts are all due within a week, whereas we're not expecting to get this for another 90 days. So those are some issues that could occur. And if you're looking at this current ratio, we could say basically we have more than enough. We have $2 that we own for every $1 that we owe. Maybe let's just go and buy some equipment, but that could be a bad idea at this point because we have so many liabilities coming up, and it could take a while for that to convert into cash to pay it off. But that's where it starts to become very much more about your situation. So this is a walkthrough of the 3 key financial statements in your business. If you have any questions on how they work, feel free to let me know. Thanks. Bye.